Energy prices also sinking. Crude hits its lowest level today since April of 21. Our Pippa Stevens has more on the implications of that. Morning, Pippa.
Good morning, Carl. Well, WTI dropping to $60.81 at the low. Tariffs and demand concerns are the overarching bearish backdrop here. But for oil specifically, the surprise announcement from OPEC Plus that they will raise output by 411,000 barrels per day come May, effectively 3 months worth of production increases, is likely the biggest driver. Now, the timing, of course, is notable, with the group officially pointing to strong market fundamentals. That is a view not shared by many market participants, at least for the time being. So there are a few reasons why the group could have done this. Some nations like Iraq and Kazakhstan have been continuous overproducers, and so it could be a signal to them to get in line with their quotas. President Trump has also repeatedly called for OPEC Plus to raise output to bring prices down for Americans, since lower oil could help offset some of the tariff inflationary pressures. Finally, OPEC could be vying for market share here. For a long time, they've been defending prices by withholding so much oil from the market, and perhaps this is now a strategy shift. So the bottom line, Carl and Sarah, is that this was already an oversupplied market. Add in tariffs and surprise OPEC moves, and there is really nothing to like here.
I mentioned earlier how this is potentially good news for the economy if we get lower gas prices, lower oil prices. It's exactly what the president wanted, but he also wanted drill, baby, drill, and I wonder what happens to those capex budgets and production if we continue to see share price pressure here and lower prices.
Yeah, so lower oil that President Trump has called for is very much at odds, with the drill, baby, drill that he wants the producers to do, but who don't want to do that, since they, of course, want those higher oil prices. There's no doubt that lower oil will help consumers. We have seen gas prices on the national average move up to the highest since September, and so that is starting to take a bite out of consumers' wallets. But when it comes to the oil and gas executives, we did hear from them in that anonymous Dallas Fed energy survey recently, and with the mask of anonymity, we heard some pretty pointed comments with, with companies saying that the administration's chaos is a disaster for the commodity markets. The only certainty is uncertainty. I've never felt more uncertainty about our business in my entire 40-plus year career. And so there is clearly a lot of chatter here going on behind the scenes, with President Trump calling, for drill, baby, drill, when these companies don't necessarily want to do that.
Yeah, the Dallas Fed qualitative commentary was one of the best reads of the week. The other question I have, Pippa, is about break-even costs, because there's been discussion of what steel tariffs are doing to the price of 5.5-inch drill pipe, whether or not that margin is getting squeezed with these lower prices even.
Yeah, so we've seen the inflationary pressures certainly rise the break-even costs for a lot of these producers, maybe in the, the north of $50 per barrel range. And so when WTI is sitting here at 61, they're still in the okay range, and they'll certainly be able to cover all of their capex budgets as well as dividends and buybacks. But it does start to bite a little bit, as you said, those steel, the piping costs, labor costs, you have to have all these raw materials, sand, all of those prices have gone up. And so that does then act as, a further drawdown on the profits. And then also it makes executives reluctant to start drilling, particularly if they're unsure about what OPEC's policy is going to look like going forward.
Okay, Pippa, thank you.